This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional. Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current, as of 5 May 2026.
Thank you so much for having me back.
Oh, it's great to have you here. So I want you to imagine for a second that you are a very successful asset manager. You know, you've just raised €1 billion.
Right.
And you've promised your investors daily access to their cash, meaning they can redeem their shares on any given Tuesday straight away.
Okay, a highly liquid promise.
Exactly. But here's the catch. You took that highly liquid capital and you went and invested a massive chunk of it into, complex private debt.
Yeah.
Or commercial real estate. Right. Assets that might take 6, maybe even 8 months to actually properly value and sell. So what happens when the market dips? Investors want their money back and you just cannot sell those assets.
Well, the fund suspends.
Yeah.
It's a complete operational freeze.
Exactly. And that exact mismatch, that structural friction, is why choosing the correct legal architecture for your fund is arguably the single most consequential decision you will ever make. And welcome to our deep dive. I am so glad you're joining us today.
It's an absolute pleasure to be here. And that scenario you just outlined, that's precisely the kind of systemic issue that the European and Luxembourg regulatory frameworks are fundamentally designed to prevent.
Right. And today, our mission is to conduct a really clinical, deeply operational comparison of two foundational pillars of the European asset management landscape. We are talking about undertakings for collective investment in transferable securities.
Which listeners will know as UCITS. Yeah.
Exactly, UCITS versus alternative investment funds or AIFs. And before we get into the mechanics of all this, I just want to set the tone for today's discussion.
Let's do it.
We are examining Luxembourg's regulatory architecture, which is supervised very constructively by the Commission de Surveillance du Secteur Financier, the CSSF. And, this framework is highly respected, it's elegant, incredibly robust, and it provides a reliable environment for managers globally.
That is, I think that's the perfect way to frame it, because the legal wrapper you choose right at the very beginning, it dictates your permitted asset universe, your distribution strategy, and ultimately your entire operational workload.
It's not just a marketing label.
Not at all. It's the absolute structural foundation.
So let's unpack this. I like to think of this initial choice like selecting the structural chassis of a vehicle before you actually build it.
Okay, I like that analogy.
Right. It's more than just deciding what the paint job looks like. If you choose the chassis of, say, a high-speed passenger train, you're committing to a very specific type of track.
Right. A defined power source, strict safety protocols.
Exactly. And if you try to bolt, heavy private debt onto a passenger train chassis, it just doesn't work. The track, which is essentially your administrator's daily valuation system, it literally cannot process those wheels.
No, it breaks the data pipeline completely.
Yeah, you can't just suddenly decide halfway through the journey that you want to take a train off-road.
That's spot on. The chassis determines the mechanical limits of what the vehicle can sustainably do.
Yeah.
So, to ground that in our source material, let's look at the first practical takeaway, which is the actual definition of a UCITS.
Let's hear it.
Under Luxembourg law, a UCIT is fundamentally defined by its public capital raising. It invests that capital in transferable securities or other eligible liquid financial assets.
Okay, wait, let's stop right there. Public capital raising and transferable securities. What does that actually mean, in plain English, for a manager sitting at their desk?
Well, it means the fund is designed from the ground up to be distributed to the general public, retail investors across Europe. And because everyday retail investors are involved, the assets the fund buys must be highly liquid. So transferable securities essentially mean shares in companies, bonds, things that can be easily priced and easily sold on a regulated market.
Right. And it operates on a very specific set of principles beyond just buying those stocks and bonds.
Right. It operates heavily on the principle of risk spreading. Right. You cannot put all your investors' money into a single stock.
Makes sense.
Furthermore, it absolutely must offer unit holder redemption at the request of those holders, out of the undertaking's own assets. So when you take all those components together, public capital, liquid assets, risk spreading, and on-demand liquidity, you have a highly harmonized, structurally disciplined product.
It's built for a very specific type of journey. But then we have the AIF side of the garage. How do we define the alternative investment fund?
What's fascinating here is that an AIS is defined almost entirely by the negative space around the UCIT's framework.
The negative space?
Yeah, it's defined by what it is not.
Oh, interesting.
An AIF is a collective investment undertaking that raises capital from a number of investors, and it invests that capital in accordance with a defined investment policy. But crucially, the legal definition rests on the fact that it does not require authorization as a UCIT's.
I have to say, I really love that regulatory approach, defining it by what it isn't. But why is that beneficial? Why not just write a highly specific list of what an AIF must be?
Because doing so would stifle financial innovation, basically. By not being bound to the strict eligible assets taxonomy of UCITs, this specific definition creates the necessary operational breathing room.
Right.
Luxembourg AIS structuring can safely and coherently accommodate strategies like private equity, private debt, real estate infrastructure.
Things that just don't fit the train track.
Exactly. These are highly complex strategies that simply do not naturally fit into a highly liquid daily dealing wrapper. So the negative definition allows the legal framework to adapt to the reality of alternate assets.
So we have our two distinct chassis, but here is where it gets really interesting for anyone listening who is, actually running a management company right now.
Okay.
How does scale change the regulatory picture for each of these? Because assets under management, or AUM, that must have a practical impact on the compliance burden.
Oh, AUM matters deeply. But it matters quite differently depending on the regime you're in.
How so?
For a UCIS, the scale of assets under management directly affects the management company's own fund's planning. There are precise capital requirements that increase as the fund scales up.
Okay, and for the alternative side?
For alternative investment fund managers, or AIFMs, AUM is the decisive dividing line between two entirely different regulatory postures. It dictates whether the manager remains within the registered sub-threshold regime or if they cross the line and must move into the full authorized AIFM regime.
Right.
And moving to full authorization brings a whole host of related passport, reporting, and organizational consequences.
Hold on, I'm getting a little lost in the weeds here. You mentioned sub-threshold regimes. What are the actual numbers we're talking about?
The crucial numbers defining the boundary are quite clear. The registered sub-threshold regime applies where the AIF's assets under management in total do not exceed 100 million euros. And that figure includes any assets acquired through the use of leverage.
Okay, so 100 million euros is the ceiling. But what if the fund doesn't borrow money? What if it doesn't use leverage at all?
Well, if the portfolios consist of AIFs that are not leveraged, and this is crucial, they have no redemption rights exercisable during a period of 5 years following the date of initial investment.
A 5-year lockup?
Exactly.
Yeah.
If they have that 5-year lockup, then the threshold is extended significantly to 500 million euros.
Wait, let me just stop you right there because that is fascinating. If I lock my investors' money up for 5 years, my threshold jumps from 100 million euros all the way to 500 million euros.
It does, yeah.
Why does the regulator suddenly trust me with 400 million more before requiring full authorization just because of a contractual lockup? What's the systemic logic there?
That is a brilliant question, and it goes right to the heart of systemic risk. See, regulators are primarily concerned with bank-run scenarios.
Where everyone panics and wants their cash.
Right. Situations where panic causes everyone to demand cash at once, forcing the manager into a fire sale of assets, which crashes market prices and hurts the broader economy.
Yeah, that makes sense.
But if your fund is unleveraged, you don't have banks knocking on your door demanding margin calls. And if your investors are contractually locked in for 5 years, you have zero risk of a sudden, panic-driven run on the fund.
Because they physically can't get the money out.
Exactly, you have patient capital. Because you pose fundamentally less systemic risk to the European financial system. The regulator allows you a much higher AUM ceiling before the full weight of the authorized AIFMD regime applies.
That makes perfect sense when you explain the mechanics behind it. It's all about cushioning the system against panic.
Completely.
So having defined the basic frameworks and the impact of scale, we really need to look at the players on the board here. We're talking about the Luxembourg ecosystem. Who exactly is operating under this constructive supervision of the CSSF?
Well, the universe is very comprehensive. On the UCITS side, this includes the UCITS funds themselves, their management companies, and self-managed UCITS investment companies.
Okay. And on the alternative side? Because whenever I look at Luxembourg alternatives, it feels like an absolute alphabet soup of acronyms.
It can definitely appear that way at first glance, but it's actually a highly tailored clinical toolkit.
Okay, walk me through it.
The relevant Luxembourg universe includes Luxembourg AIFMs and the AIFs they manage. Specifically, where the legal criteria are met, this covers Part 2 undertakings for collective investment, specialized investment funds, which we call SIFs investment companies in risk capital, known as SICARs, and reserved alternative investment funds, or RAIs.
Okay. For the sake of the listener who might be, prepping for a board meeting right now, we can't just list acronyms. Let's briefly unpack what those actually do in practice. Let's start with a SIF. What exactly is a SIF?
So a SIF, or specialized investment fund, is designed for well-informed investors. It offers incredible flexibility. A SIF can invest in virtually any type of asset, from traditional stocks to vintage cars to real estate.
Wow, really?
Yes, provided it adheres to a basic principle of risk spreading. And it is an AIF that is directly supervised by the CSSF.
Got it. And how does that differ from a SICAR?
A SICAR, an investment company in risk capital, has a very specific mandate. It is designed exclusively for private equity and venture capital.
Oh.
Yeah, its entire purpose is to invest in assets that carry a higher risk with the intention of developing the target companies. And interestingly, unlike a SIF, a SICAR does not have a mandatory risk spreading requirement.
Really? Why is that?
Because the very nature of private equity might mean taking a highly concentrated, high-conviction position in a single company. You wouldn't want to force them to spread that out artificially.
That distinction is crucial. Okay, so what about the RAI, the Reserved Alternative Investment Fund?
The RAI is arguably one of Luxembourg's most successful innovations. Structurally, it operates very much like a SIF or a SICAR, but with one profound difference. The fund itself is not directly authorized or supervised by the CSSF.
Wait, really? A Luxembourg fund that is not directly supervised, how does that even work within a strictly regulated ecosystem?
Well, the regulation is shifted to the manager level. Our RAIF absolutely must be managed by an authorized external AIFM.
Ah!
Right. That AIFM is fully regulated and supervised by the CSSF or another European regulator. By shifting the regulatory burden to the manager, the RAIF can be brought to market much faster, which is highly attractive for institutional promoters.
Okay, that clears that up. And finally, the Part 2 UCI.
A Part 2 undertaking for collective investment is essentially an alternative investment fund that can be distributed to retail investors.
Retail investors. I thought AICs were mostly professional.
Usually, yes. But because a Part 2 UCI targets the public, but does not qualify as a UCIs, perhaps because it invests in slightly less liquid assets or uses different borrowing limits, it is heavily regulated locally to protect those retail investors.
Understood. So we have the players, SIFs, SICARs, RAIFs, Part 2 UCIs, and of course the UCIs themselves, which brings us to a fascinating structural question.
Okay.
Both the UCITS framework and the Alternative Investment Fund Manager's Directive AIFMD, they are European Union frameworks. So how does Luxembourg law actually interact with Brussels here?
This distinction operates at two interacting levels. You have the European Union level, which sets the harmonized standards and creates the cross-border marketing passports.
Right.
But a European directive doesn't simply hover in the air. It has to be brought to life, implemented, and supervised through local national law.
So the European passport logic has to be translated into local Luxembourg product law.
Exactly. It translates into real, tangible things. CSSF filings, fund constitutional documents, distribution arrangements, depository oversight agreements, board governance structures, and ongoing operational reporting.
And the regulatory philosophies behind UCITS and AIFMD, they are entirely different, aren't they? I mean, they have completely different protective logics.
They do. And they are highly complementary rather than adversarial.
Yeah.
The UCITS discipline is fundamentally about protecting retail investors at the product level.
The product level?
Yes. It does this through strict, hard-coded rules on what the fund can buy, mandatory risk spreading, guaranteeing high liquidity so the investor can leave when they want, and highly prescribed disclosure documents. The protection is baked right into the fund itself.
Whereas the AIFMD discipline shifts the focus away from the product.
Precisely. AIFMD focuses on manager risk. Because alternative funds deal with less liquid assets and professional investors who can handle more risk, the regulation targets the entity pulling the levers.
The driver of the car.
Exactly. AIFMD regulates risk management systems, liquidity management protocols, leverage limits, depository arrangements, and systematic supervisory reporting to monitor systemic risk across the board.
That makes perfect sense. UCITS regulates the car, AIFMD regulates the driver. Now, we need to talk about the operational timeline. We are sitting here on the 5th of May, 2026. The core distinction between UCITS and AIFs is decades old. But there has been a very significant recent operational update that every manager needs to be aware of.
Yes, there has. What is highly current right now is the operational layer added by the law of 3 March 2026. This law formally amended the Luxembourg 2010 law and the 2013 AIFM law.
Right.
This was done in connection with what the CSSF refers to as AIFMD2 and UCITS 6.
And this brought about a very specific, strict requirement regarding liquidity management tools, correct?
That's correct. Luxembourg UCITS, or their management companies, alongside Luxembourg-authorized AIFMs managing open-ended AIFs, they had a rigid operational deadline. They were required to communicate their selection of liquidity management tools, complete with detailed activation and deactivation policies, directly to the CSSF.
Let me put myself in the shoes of a compliance officer during that period. I can only imagine what mid-April looked like. What exactly are these liquidity management tools, and why did the CSSF mandate this so strictly?
Well, liquidity management tools, or LMTs, are mechanisms like redemption gates, swing pricing, or anti-dilution levies.
Okay.
Imagine a scenario where a large number of investors want to redeem from an open-ended fund all at once. If the manager has to sell assets quickly to raise cash, they might get a bad price, which unfairly harms the investors who are staying in the fund.
That's a classic problem.
Right. So LMTs allow the manager to gracefully manage that outflow, perhaps by gating redemptions to a certain percentage per week, or by adjusting the share price so the departing investors bear the cost of the asset sale, not the remaining investors.
It's really about fairness and stability, and this selection had to be done by the 16th of April, 2026, using a very specific digital channel, right?
Yes, exclusively via the dedicated eDesk liquidity management tool selection module. The new tool requirements took effect on that exact same date, the 16th of April, 2026, which is also when the eDesk activation module was officially launched.
A major shift.
It represents a massive shift toward entirely digital, structured, supervisory interaction.
So we have the history, we have the recent legal updates, and we understand the alphabet soup of funds. Now we arrive at the critical execution phase. How does a manager actually make this choice in practice when setting up a new fund? Because from what I read in the sources, it boils down to 3 highly clinical structuring questions.
Indeed. It's a systematic process. You cannot just guess your way through this. The very first question a manager must ask is, can the underlying assets genuinely fit within the UCITS eligible assets perimeter?
I really want to dig into this because this is the decisive legal hinge. I like to think of the UCITS eligible assets perimeter like a strict nutritional plan for an elite athlete preparing for the Olympics.
Okay, I see where you're going.
You cannot just feed the athlete a donut because it looks commercially attractive or happens to taste good. Every single calorie, every ingredient must fit a very strict, pre-approved nutritional taxonomy. If the CSSF has not approved that ingredient as liquid and transparent, it does not go into the body.
That is a highly accurate way to look at it. The asset must mathematically and legally fit the taxonomy, and the fund must respect the related risk spreading, borrowing, and risk management constraints. The rules are absolute.
Let's talk about those borrowing limits, because that is where a lot of managers trip up. What are the specific numerical constraints?
The borrowing constraints are tightly controlled to prevent leverage-induced collapses. All UCITS may borrow up to 10% of their assets, but strictly on a temporary basis.
Temporary.
Yes, it's a liquidity buffer, not a structural investment strategy.
And there is a small allowance for property, right? Let's say the fund needs an office building to operate from.
Yes, UCITS investment companies may additionally borrow up to 10% of assets to acquire immovable property that is essential for the direct pursuit of their business.
Okay, so that's 10% temporary plus 10% property.
However, and this is where the regulator's elegance really shows, the total borrowing cannot exceed 15% of assets where both of those allowances apply.
Oh, that is clever. So if you max out your temporary borrowing at 10%, you only have 5% left for the property. You cannot just stack the limits to get 20%. The absolute ceiling is 15%.
Exactly. The perimeter is mathematically guarded.
Now, what about the AIF side of that first question? How does the CSSF view asset eligibility for an alternative fund?
The AIF structuring is much broader, but we must be clear. It is highly regulated. For CSSF Supervised Part 2 UCIs and CEFs, we look to CSSF Circular 25901.
And what does that say?
This circular outlines that the concept of assets encompasses, in principle, any type of investment that may be entrusted to the depositary for safekeeping.
That is a remarkably wide universe. If the depositary can legally safeguard it and track its ownership, the AIF can generally hold it.
Generally, yes.
But there is an interesting caveat for SIFs that try to act like UCITS, isn't there?
Yes, there is a very deliberate anti-arbitrage provision. The same circular clarifies that if a SIF or a Part 2 UCI has a main objective of investing in UCITS eligible assets like liquid stocks and bonds, it must have an investment and borrowing policy that is definitively different from that of a UCITS.
Why? Why would the regulator care if an AIF decides to hold safe liquid stocks?
Because of the exemption in the UCITS directive. If a fund is raising capital to invest in liquid assets, it should generally be regulated as a UCITS to ensure retail protection. If you use a SIF wrapper, which has lighter product rules, simply to avoid UCITS compliance while running a nearly identical liquid strategy, that is, regulatory arbitrage, the CSSF requires the SIF to demonstrate that its policy, perhaps through higher leverage or concentrated positions, makes it fundamentally distinct from a UCITS.
That makes total sense. You cannot just wear an AIF costume to avoid UCITS rules.
Yeah.
Okay, so question 1 is asset eligibility. What is the second clinical question for our manager?
The second question is about behavioral mechanics. Is the liquidity profile consistent with the promised redemption terms?
Give me an example of how that breaks down in practice.
Well, imagine you structure a fund promising investors daily liquidity. They can exit whenever they want.
Okay.
But you take their money and originate a portfolio of 5-year private loans to mid-sized companies. A month later, a macroeconomic shock hits. Investors panic and submit redemption requests. You look at your portfolio and all you hold are illiquid 5-year loan agreements.
You can't sell them.
You cannot sell them on an exchange. You cannot generate the cash to pay the investors. The fund suspends trading. Trust is destroyed, and systemic friction begins. The assets and the redemption terms must be in perfect mathematical harmony.
And the third question?
The third question addresses the commercial distribution strategy. Who is buying this? Are you targeting everyday retail investors across multiple borders, professional institutional investors, domestic markets, or a bespoke combination of these channels?
So if you're a manager listening to this and you answer those 3 questions and your results point to liquid transferable securities, daily dealing, and a desire to market broadly to retail investors across the European Union, UCITS is your natural, undeniable route.
Correct. But if your strategy involves originating loans, holding private equity stakes, managing infrastructure projects, or investing in real estate, and your investors are professional entities who understand that their capital will be locked up for years,
then the AIF route is the only coherent starting point, subject to the applicable product law. This transitions us perfectly into the operational playbook. We've discussed the high-level regulatory philosophy, but how does this actually look in the trenches? Let's talk about day-to-day operations and drafting logic.
The primary operational reality that catches many new managers off guard is that product selection absolutely must precede legal drafting.
You cannot just hire a law firm, tell them to start writing a generic prospectus, and figure out the specific fund type later.
No, absolutely not.
Right.
A UCI spectus, for instance, is not merely a marketing document or a commercial pitch. It is the operating constitution of a regulated liquid product. Every single sentence has an operational consequence.
Right.
Therefore, the eligible assets language, the mathematical diversification limits, the protocols for derivative use, the collateral mechanics, the selection of those liquidity management tools we discussed, and the distribution disclosures. They must be perfectly aligned from page 1.
The CSSF is very clear on this discipline, aren't they?
They are uncompromising. The CSSF's UCITS FAQ reinforces this by explicitly stating that a UCITS should clearly disclose in its investment policy the specific categories of eligible assets in which it is authorized to invest. Ambiguity is not permitted.
So that is the UCITS side. It is rigid, harmonized, and exact. What about the documentation execution for an AIF? It must be different since the assets are so varied.
For an AIF, the core documents require meticulous interconnected alignment. You must reconcile the offering memorandum, the limited partnership agreement or articles of incorporation, the AIFM agreement, the depository agreement, the delegation framework, and the internal valuation and liquidity policies.
It's a web.
It is a web of contracts. Furthermore, the consolidated AIFM law requires highly specific investor disclosures on illiquid assets, bespoke liquidity arrangements, risk profiles, leverage, and notably for loan originating AIFs, the exact composition of the originated loan portfolio.
You mentioned distribution earlier as one of the three structuring questions, and it clearly dictates a lot of this documentation logic. UCITS are structurally built with a European passport for broad cross-border distribution.
Yes. Subject to the relevant notification and host state rules, a Luxembourg UCITS is designed to move across European borders efficiently and be sold to retail investors. AIF distribution, however, is much more segmented.
How so?
The consolidated Luxembourg AIFM law frames the AIFMD marketing passport around professional investors.
Which means if you want to sell an AIF, your investor access strategy has to be mapped with incredible care. You are not just putting it on a retail platform.
It does, and it's vital to note that this segmented approach does not make AIFs commercially weaker or inferior in any way. It simply makes them different, tailored for a different type of capital and a different type of strategy.
Let's circle back to something we touched on earlier. The context of assets under management and the specific capital requirements. We need to break down the actual numerals here, because if you are planning a management company, these are hard operational facts you absolutely must budget for. Let's start with a Chapter 15 UCITS management company. What is the financial barrier to entry?
Under Luxembourg law, a Chapter 15 UCITS management company requires an initial capital base of 125,000 euros.
Okay, 125,000 euros.
But that is just the starting point. Furthermore, there is an additional own funds requirement tied directly to the scale of your success. This is calculated as an amount equal to 0.02% of the amount by which the portfolio value exceeds 250 million euros.
Okay, let's do the math live on the show so we understand how this scales.
Sure.
Let's say I launch a wildly successful UCITS fund, and it grows to, 1.25 billion euros in assets.
Right.
How much extra capital does my management company need to hold?
Let's break it down. Your total assets are 1.25 billion. You subtract the base threshold of 250 million. That leaves you with 1 billion euros subject to the calculation.
Yeah.
We multiply that 1 billion by 0.02%. That equals 200,000 euros. So your management company must hold its base 125,000 euros plus an additional 200,000 euros in own funds.
That is a very precise operational buffer, and there is an absolute ceiling on that requirement, correct?
Yes, that additional own funds requirement is subject to a hard cap of 10 million euros. This ensures the management company has sufficient skin in the game and operational resilience without requiring an infinite capital inefficient hoard of cash.
Okay, 125,000 euros base plus 0.02% over 250 million capped at 10 million. Very precise. Now, we already discussed the AIFM thresholds, the 100 million with leverage or 500 million unleveraged with a 5-year lockup.
Right.
If a manager crosses those lines, they move into full authorization. And this leads us to the reporting architecture, which is where that early classification decision, UCITS versus AIF, becomes highly operationally visible on a daily basis.
It absolutely does.
This raises an important practical question for me. If a manager gets the legal classifications slightly wrong or, tries to creatively force an alternative strategy into a UCITS wrapper because they really want that retail distribution, does the administrator's data model just break down? What actually happens behind the scenes?
It creates immense, sometimes terminal operational friction.
Mm-hmm.
In live practice, the legal classification decision absolutely should be tested against the fund administrator's daily data model before launch. You do not want to be repairing this retrospectively.
Walk me through a scenario where it breaks.
Consider the reporting requirements. UCITS are required to maintain highly sophisticated daily risk management arrangements, and they must systematically communicate derivative-related information to the CSSF.
Daily?
Yes. Their systems are built to ingest daily market prices from Bloomberg or Reuters, run value-at-risk calculations, and output a daily net asset value. If you force an illiquid private debt instrument into that pipeline, the system asks for a daily market price.
But the asset doesn't have one.
Exactly. The asset does not have one. The system halts. The valuation team has to perform manual overrides, which introduces operational risk, audit flags, and massive delays.
It is exactly like the chassis analogy earlier. The operational track literally cannot process the wheels. And AIFMs have a completely different data pipeline, don't they?
They do. AIFMs have a fundamentally different set of metrics tailored to systemic risk. They must report to the CSSF on principal instruments, market exposures, geographic and sector concentrations, illiquid asset categories, the results of liquidity stress tests, and comprehensive leverage-related information.
That's a lot of data.
It is. And the CSSF also retains the constructive possibility of requiring additional reporting where necessary to monitor systemic risk across the European grid.
So the data pipelines, the frequency of reporting, the very nature of what you are telling the regulator, it's fundamentally different. It's abundantly clear why choosing the right chassis on day one is vital. To illustrate why this operational discipline matters so much, we should look at the sheer scale of the Luxembourg market. We are talking about a central European fund domicile here. This is not a niche laboratory. This is the engine room of European finance.
The market context is indeed substantial, and it underscores the success of this regulatory architecture. We can look at the highly recent data from CSSF Press Release 2609, which was published on the 28th of April, 2026.
What does the pulse of the market look like? Give us the numbers.
The CSSF reported that, as at the 31st of March, 2026, the total net assets of Luxembourg undertakings for collective investment, which comprises UCIs subject to the 2010 law, SIFs and SICARs, amounted to an extraordinary 6,207.822 billion euros.
Let me just repeat that so it sinks in for everyone listening. 6,207.822 billion euros, over 6 trillion euros. That is a staggering figure. It's hard to even conceptualize that amount of capital.
It is immense. And the same official press release noted that this value is held across 3,002 separate undertakings and encompasses 13,297 active fund units.
Those figures really drive home a critical point. The UCITS versus AIF distinction is not some theoretical academic debate taking place in a university lecture hall. It is the daily, grinding, operational reality for trillions of euros of global wealth.
Exactly. And the market consensus is highly mature on this point. UCITS and AIFs are not competing labels fighting for the same commercial need. They are complementary pillars supporting a diverse financial ecosystem.
Right. UCITS remains the disciplined, harmonized route for liquid, eligible asset strategies aiming for broad distribution. AIFs provide the highly regulated, flexible structuring space for alternative strategies, professional investors, and bespoke governance. The question a manager should ask is never which regime is easier, because neither is easy. They are both rigorous.
The correct analysis is always, which regime can carry the strategy honestly, efficiently, and sustainably?
And carrying that strategy sustainably increasingly relies on digital execution. We touched on eDesk earlier regarding liquidity management tools, but the CSSF is heavily focused on digitizing the entire supervisory relationship, correct?
Very much so. The recent regulatory pulse is firmly focused on digital execution and standardization. We saw a clear example of this just a couple of weeks ago, on the 22nd of April, 2026.
What happened then?
The CSSF announced that the eDesk procedure for cross-border management notifications, as well as denotifications with a European passport, was definitively available for Luxembourg-domiciled investment fund managers.
Does this apply to both regimes or just UCITS?
It applies across the board. The official communiqué specifically concerns UCITS management companies operating under Chapter 15 of the 2010 law, as well as authorized AIFMs. It mandates that as of that date, notification and denotification files must be transmitted exclusively through the eDesk portal or through Structured Application Programming Interface, or API, channels. Furthermore, all subsequent monitoring and supervisory interaction regarding these passports is carried out exclusively through eDesk.
So the era of emailing PDFs or sending physical letters for cross-border passports is over. It is API to API. With that digital infrastructure so firmly established, let's look ahead. What are the strictly scheduled regulatory milestones that managers absolutely must adhere to in their operational planning?
The first milestone is not just ahead of us. It is already an active, ongoing requirement that managers must be living right now. As we discussed regarding the Law of 3 March 2026, since the 16th of April 2026, Luxembourg UCIs, or their management companies, and authorized AIFMs managing open-ended AIFs are fully operating within the new liquidity management tool execution environment via eDesk.
So if you are an active manager, your LMT policies are already mapped, filed, and digitally integrated. What is the second fixed milestone we need to watch?
The second fixed point concerns a highly specific asset class, loan-originating AIFs. This is an important transitional provision under the consolidated Luxembourg AIFM law, as amended by that same law of 3 March 2026.
So what does this all mean for managers who already have existing loan originating funds, funds that were launched years ago under different assumptions? Do they have to suddenly restructure overnight?
No, the Luxembourg framework is pragmatic. It provides a very structured, calm transition. AIFMs managing loan-originating AIFs that were formally constituted before the 15th of April 2024 are deemed to comply with specified new loan origination provisions until a hard deadline of the 16th of April 2029.
Okay, so they have a 5-year grace period. But there are strict operational conditions attached to that transition period, I imagine? They cannot just do whatever they want for 5 years.
Absolutely not. They are deemed compliant strictly provided they respect statutory conditions. Notably, this includes absolute restrictions on increasing their relevant loan exposure or increasing their leverage above the specified limits during that entire transitional period.
Ah, I see.
The fund can run its course, but it cannot expand its risk profile under the old rules.
And there was a third point mentioned in our source materials regarding the European Securities and Markets Authority, or ESMARI.
Yes, but we must treat this one very carefully as it does not have a fixed legislative execution date yet. ESMA issued technical advice on the 26th of June, 2025, regarding a comprehensive review of the UCITS Eligible Assets Directive.
That is huge. That is addressing the very interpretation of what actually counts as an eligible asset, which is the foundational question we discussed earlier.
Exactly. This review is highly relevant to the boundary line between UCITS and AIFs. However, as of this briefing on the 5th of May, 2026, the next legislative date for any resulting amendment remains to be confirmed by the European Commission. We only focus on confirmed fixed dates for operational planning to avoid speculation.
That is a very prudent approach. Only build the infrastructure for the laws that are actually on the calendar. Okay, we have covered an incredible amount of ground today. We understand the definitions, the negative space of the AIF, the capital requirements, the reporting pipelines, and the digital milestones.
We really have.
Now, it is time for mastery. We need to synthesize all of this theory into a concrete start-to-finish structuring scenario. Let's play this out. I will be a commercial promoter arriving at your office. I have an idea that I think is quite simple, and I want you to tell me how to build it.
Let's hear the pitch.
I want to launch a Luxembourg fund. I want maximum European distribution. My portfolio will be a mix, some highly liquid corporate bonds, but also a significant, let's say 40% portion of illiquid private debt exposure to mid-market enterprises. And above all, I want to keep the product completely flexible so I can change strategy if the market shifts. How do we build this?
It is a classic scenario, and the very first task is not to open a Word document and start drafting a prospectus. Your first task is to cleanly, coldly separate your commercial ambition from the legal architecture.
But wait, the liquid corporate bonds part sounds perfectly like a UCITS, right? And I told you I want maximum European distribution, which the UCITS passport gives me. So let's just make it a UCITS and throw the private debt in there as a diversification play.
The liquid bond component might suggest UCITS, yes. But the private debt component immediately creates profound structural friction within a UCITS wrapper. It raises immediate complex questions regarding eligible assets, liquidity profiles, valuation mechanics, leverage limits, depository oversight, and investor disclosure.
So if I push back and I try to force this private debt into a UCITS simply because I aggressively want that cross-border retail distribution label, what actually happens? Walk me through the failure.
Forcing private debt into a UCITS wrapper leads directly to incoherent documentation. You will struggle to explain to the CSSF how an illiquid mid-market loan qualifies as a transferable security. More dangerously, even if you somehow launched it, it leads to severe operational friction regarding how you value those illiquid assets daily and how you manage the strict temporary 10% leverage limits. The launch might look acceptable on a whiteboard in a marketing meeting, but it will become deeply inefficient, mathematically strained, and potentially impossible in live daily operation. When a retail investor asks for their money on a Tuesday and 40% of your fund is locked in private loans, the vehicle stalls.
So the operational track simply cannot process the wheels. What is the correct playbook for my scenario then? How do I actually achieve my commercial goals?
The correct playbook is clinical operational mapping. We map the assets, the required redemption terms, the target investors, the specific distribution countries, the required manager status, and the administrator's data reporting capacity before we even discuss the legal wrapper. We do not let the tail wag the dog.
And once we map that out realistically,
we make a clean, coherent product decision. If you insist on the private debt, you cannot have the retail UCITS passport. We use the UCI's route exclusively for genuine liquid strategies that require and can mathematically support broad retail distribution and daily dealing.
And for the alternative portion,
we use the AIF route, perhaps a SIF or a RAI managed by an authorized AIFM for alternative assets like your private debt, where you absolutely need negotiated liquidity terms, tailored governance, and are targeting professional or well-informed investors who understand the lockup periods.
It is about aligning the engine with the chassis and ensuring the track can actually support the weight of the train.
Luxembourg is uniquely relevant here because it combines large-scale, cross-border UCITS infrastructure with a deep AIF toolbox, so the real value lies in choosing the correct route early and then making the documentation, service provider model, and supervisory interactions match that choice.
That brings everything together perfectly. We have covered a tremendous amount of ground today. From the fundamental definitions of public capital versus defined investment policies, all the way through to the mathematical realities of capital buffers and the highly digital e-desk-driven reality of modern compliance.
It's been a great discussion.
If you are sitting there listening to this and mapping out your next fund launch, I want to leave you with a final thought to ponder. We have seen how the CSSF is mandating exclusive digital channels like e-desk and API structures for critical supervisory interactions, whether that is liquidity management tool selection or cross-border passporting. As these digital reporting platforms become the absolute non-negotiable standard across Europe, how might a fund's initial foundational legal classification, UCITS or AIF, further dictate its long-term technological and data infrastructure needs? You are no longer just choosing a legal wrapper, you are choosing an IT architecture. The data model you choose on day one is going to be the pipeline you rely on for years to come.
Absolutely. The technology and the law are completely intertwined now.
Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Subscribe to Bertrand Mariaux and Rigore Media on YouTube. Connect with Bertrand on LinkedIn at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.